A Tale of Nine Cities. This name, by the way, was created by my partner, Vic. Vic, why don't you stand up a second, okay? He never gets any, yes, stand up. Let everybody see you. All right. He said one day, exasperated, he called me on a Saturday. This is, God, about 5-6 years ago. And he was going, my God, everything's so changed out there. Every city's doing its own thing. He said, it really is a tale of 9 cities out there. And I go, whoa, that's a good, nice little name, Tale of 9 Cities. So we adopted it for this presentation. And we're going to be talking about the 9 cities here. But before we get into that, I want you to bring your attention to your handouts, okay, in your packets. So open those up. Okay. Now, what is this? Well, a couple of years ago, we decided to do what we call subdivision analysis, because the area out here in Coachella Valley is not like any other area in the world, as you probably know. Normally, you go to a city like Lakewood or Laguna Niguel, or and it's a consistent, homogeneous community with some variation. But my goodness, out here, the homes range from 200,000 to 5-10 million. You have this huge spectrum, and then you find out when you look at the city prices, it's this average of all these different subdivisions that go from 200,000 to 1 million. So the normal statistical analysis has a certain inapplicability for the region. So we found out you have to look at each subdivision a little bit like a jigsaw puzzle. In other words, a city is composed of maybe 50 pieces, each one walled off from the one next door, and each one have kind of with its own little lifestyle and community. So we decided to do what's called subdivision analysis, and that is to treat each country club and development as a city unto itself and apply the standard housing metrics to that, okay? And that resulted in this. And something for the first time we think that homeowners want to see. Homeowners don't want to know what the median price is in Palm Springs where they live. They want to know what the price is in their community right around where they live. For the first time, we're able to provide that. And for example, I want to bring your attention, this is the first page called the top 40, because we take the top 40 selling country clubs and subdivisions. We rank it by dollar sales. So on the left side is the name of this subdivision. The next is whether it's attached or a detached community. And then the monthly HOA fee, units listings in that subdivision. And this is, by the way, at the end of the year. So that's why it's called 2000. It should be 2019, I'm sorry. It says 2020, it should be 2019. Yeah, I made this one. They did it right. And then we have 12-month average sales, unit sales. You can see, for example, Sun City has 371 unit sales over the last 12 months. Toscana has 56. And we have months of supply, which is inventory divided by the average sale rate. Then we have total 12-month sales. Average price per square foot. That's probably the best metric, as you know, to measure what's going on in an area, because you have different size homes, but the price per square foot is a much more stable metric. It doesn't vary with the price of the size of the home as much. It's what they call a lower order mathematical equation. So it's more stable. 12 months change in that. Average damn days on the market, medium number of days on the market. And then the last one is the average square foot. So it shows you the average size of the home in that development. So it's a very in-depth analysis that goes to the next level down of what's going on in the housing communities out here over and above the normal metrics that you get for cities, et cetera, et cetera. So we think it's an important addition to the information that you now have. It's made courtesy of Franklin Loans. Thank you. Okay, I wanted to bring that to your attention because I'm going to give you a little treat today. We've got to introduce some new ideas. We're going to do an analysis of the luxury home market for the first time. I'll show you how we do that. We're going to take those subdivision thing and put them together like pieces. Okay, well, I'll explain that as we get into it. Okay, let's go to the next slide. So outline of today's talk, we're going to talk about the Valley's housing stock. The homes out here. How many homes does each city have? What type of homes are they? The review of the 2019 Coachella Valley housing market by the numbers. Okay? An in-depth look at the Valley's luxury home market. For the first time, subdivision analysis allows us to put country clubs together in classes. And we're going to show you what the luxury market's doing for the first time in detail. Are financial and home prices forming another bubble? No, I have a no here. Well, that's going to be an interesting question because some people are wondering about that. Well, one reason, I'll show you why as we go forward. So what are the top professionals really worried about? What are the real pros? Get away from the normal things that are discussed in the public. What are the pros really worried about? And then we're going to show you our forecast for 2020. Okay, so let's go to the next slide. Housing stock. On the left column, we have the cities, so the 9 cities: Cathedral City, City of Coachella, Desert Hot Springs, Indian Wells, Indio, La Quinta, Desert, Palm Springs, and Rancho Mirage. And then the next column over, the total number of homes, condos or single-family residences in that city, the percent that are single-family residences, and then the percent that are condos. Now, normally, you get kind of a, like, there's no, for example, in the Temecula area, Marietta, Temecula, there's very few condos. They're almost all single-family homes. In Laguna Niguel and Aliso Viejo, that area of Orange County, you have a lot more condos, so it varies. And you can see here, the Palm Desert, Palm Springs, Rancho Mirage. One is Palm Springs has 27,238 homes, has the highest number of homes of all the cities. It's followed by Palm Desert, almost with the same, 26,000 effectively. And of that, single-family residences are only 45%. Okay, you almost have 55% are condos, which is a whole different metric, which you'll see as we get into the ownership type. But on total, about 70% of all the homes out here, because Indio is a big, Indio Cathedral City, there's a lot of homes in there, and that brings the average down. So 70% mix of single-family residences and about 30% condos, okay? Now, relative, I threw this one in as a last-minute slide because it measures, it shows you some interesting numbers and shows you what's somewhat unique about this area. I have 4 counties, Riverside County, LA County, Orange County, and San Diego County. The total number of households in each county, there's 711,000 households in Riverside County. LA County has 3.3 million households. Orange County, 1 million. San Diego, a little over 1 million. And then the number of sales, home sales in that county. And if you divide that, you get the number of households it takes to generate one sale. For example, you get 1 sale per 21 households in Riverside County. LA County is 59, almost 60. It takes 60 households to generate 1 sale. San Diego County is 75. Now, Coachella Valley is 1 out of 15. It takes 15 households. And because of that, you guys represent about 30% of all the sales in Riverside County. It's 29.1, but 30 sounds better. Easier to think about. 30%. And so that's an interesting thing. Now, why? One of the reasons is, why is Coachella Valley, you get more sales per household in effect? Because there's another component in the equation that we're going to address. Okay, let's go to the next slide. Now, let me define this. A second homeowner who has a second home here is not considered a householder in this area. Householders are only defined as people who live in that area full-time. So if you own a rental property here, or you have a second home here, you as a person are not counted as a householder of that area. Only people who live here over 6 months out of the year. Well, so how are you going to get that number to come down to 15 households per sale? Well, because there's a lot of homes here that are owned by people who don't live here. Okay? So we have the classification of owners. You have an owner-occupied house, which is owned and occupied by the person who owns it, and then you have a remote owner. Remote owner is someone who either rents the property or they use it as a second home. And these are the numbers. The light blue are the number of remote owners, For a member of the household, we had 27,000. Where is it? 27,000. That's all the homes in Palm Springs. 17,000 are owned by people who don't live here. 10,000 by people who live here. Well, see, this is a completely different dynamic. You'll find no area in the world. Well, I can't say that. There's a few places, not very many. You might say Scottsdale. No, Scottsdale doesn't have these kind of metrics. It's let's just say it's very unique in the fact that we've got something here that is unique, and it takes a little deeper analysis. And if anything, what we've tried to do as MarketWatch is research and provide you with deep and information on how this market works, because it is so unique. The standard models that people usually utilize to explain what's going on in markets don't work here. They're well intended, but they don't take the time because it takes a lot of digging to figure out how this works, you know. So we have a model, MarketWatch's Valley Housing Model. The Valley's housing market is an approximate 50-50 mix. It's actually 52-48, but that's okay. Of owner-occupied owners and remote owners. Remote owners are driven by, these are people who don't live here, but they come and visit, are driven by second home or investor wants and needs. The wealth effect, a lot of them come here and just buy it cash. Lifestyle desires, winter weather relief, investment and or rental income. Those are the primary factors. Notice you don't have raising kids. You know, that's the other. Owner-occupiers are driven by the desire to own. Interest rates affect their ability to buy a home. Affordability ratings, in other words, the price of the home divided by, you know, how much you can afford, et cetera, how many people can afford the average home. Credit ratings, wages, employment growth, and population increases are all factors that drive that second market. So you have here, this is what makes it so interesting. You have here a two-component thing. You know, one thing is simple. You can't make anything complicated with one. One is, what's that song? One is the loneliest number. Or something. You can't, you know, but two, suddenly you get more, well, you know what a marriage is like. You enter two. One person lives quite happy with themselves. Two, you get this. So you've got this. Anytime you bring two things together, you get more interplay together. And they're not driven by the same factors, which makes it interesting. So because of that, we've developed 3 seminars. We have one on the owner-occupied market, which is in November. The one in May is coming up. We'll be on the second home market. We're going to do a lot of new research on that one to help you out. And then today's one. So we have this model. We think we found it useful to think in this way. So let's go into that. Finishes the part about the housing stock and ownerships, et cetera, and what makes this area so unique. We're going to go through the numbers now, okay? Let's go to the first slide. Now this looks like the chart that we show in the monthly report that you get, except I've replaced the median price by median price per square foot. That's because we know that some of you like to use median price to show clients, because that's what they're familiar with. But you, being professionals, think much better in price per square foot. There's a reason for this too. This one has a lot less, as I mentioned, variation, because sometimes statistically you're going to have variations when you're looking at 500 sales. There's going to be a different size homes you're measuring. So the median price doesn't always reflect that. Median price per square foot takes away that variable and is much more stable. And that median price per square foot for the whole 9 cities is up 7% for the region. That long-term blue chart represents 3% growth, 3.5% growth. Now someone might say, why do you show this long-term chart? Well, I'll tell you why. You say, well, what's important is just what happened last year. No, it isn't. Yes, it is, but no, it isn't. Okay, you should always understand where you are in the long-term scheme of things, because markets, from my experience, tell stories. The story isn't a one-year story. It's a pieced-together story. And this story really tells you the whole thing. I could get into the details of it. We don't have enough time to do it. But it does show the bubble, the crash, the basing period that lasted 3 or 4 years, in which all the foreclosures, the overwhelming number of foreclosures got worked through. Prices were way below where they should have been, sprung back, and then we've been going right up that line. So it does tell you the story that we've been really on a recovery. That first big move back up was really just a snapback from the undervalued situation we had during the foreclosure period. And then the move since 2013 has we've been in this upward movement, driven a lot by interest rates reduction of, but also by wage increases too. So it's been a combination of both. So there's a story in showing a long-term picture, because everything become referenced according to that. This is for detached homes, and for attached, next slide, we have a similar picture, but the attached market has not been performing as well as the detached market. There's a reason for that a little bit, which we won't get into right now. That'll be a talk for May. We have more to cover. But the attached market is not doing, even though it did 4.7%, and it's doing very well, not too well the last 6 months. So we'll get into that in May. Okay, and the next slide, sales. Now, I'm not going to go over every number on there. I gave you this table for reference purposes only. So you can go home or look at these things in a more leisure moment. They're by city. What it is we have the price ranges by city has gone from 14.9% down to Indian Wells, which is up 1.3%. We have the gains off the low, percent from the high. And this is also in price per square foot. As I mentioned, Palm Springs is 6.5%. It's the only city, by the way, that is above its 2007 high. Only city. The other ones are getting closer. Cathedral City is 11% away. But so it shows the spectrum. Again, very interesting. They confirm what we just saw. And the next slide, we get into sales. Now, sales, again, I'm not going to go over all the numbers. We have sales by city for detached homes, attached homes, and total, okay? In unit sales and in dollar sales. Dollar sales is what makes you money, so it's always good to know dollar sales. But again, I'm not going to go over each city. This is for your reference. There's about 9,800 sales in these 9 cities in 2019, down 1.8%. We projected last year at the tail of 9 cities down about 8%. We were a little short, or came up short, which is good. Yeah. All right, that's good. Notice dollar sales, though, is up about 4%. Why are dollar sales up and unit sales down? Price of homes went up. How much? -2 and +4, about 6%. And that's just about what we saw, so that all makes sense, okay? Let's go to the next slide. Because it looks like sales are raising a little bit again. We had last year where sales were off, but now we've learned something interesting going over all the numbers out here. One of the interesting things we've learned is that if you look at what's happening in the off-season and compare it to the previous off-season, you can kind of get a forecast of what's going to go happen during the on-season. And the best way to show that is 3-month sales, okay? The top line is the total of the last 3 months of sales. So this would be October, November, December, because this is January numbers, December numbers, I'm sorry. We've been averaging 712 unit sales a month for the last 3 months in December, compared to 685. Okay? Now so it shows that sales have been rising. So you can expect sales this year, if this idea holds true, and so far we've seen it hold true consistently for the last 6 or 7 years. A pattern that established itself in the off-season continues into the on-season. So I think you'll see sales for all of 2020 being greater than it was last year. That's what this points to. Okay, let's go to the next slide. Inventory, that's the other side of it. Sales really represents demand or buying. inventory has been, as it is in many regions, almost everywhere, has been declining since, at least in our area, since a peak of 6,000 sales, inventory back in January. Now, because of seasonality, you can only compare inventory or sales against the previous moment in past years. So you can't compare inventory in January 1st against April 1st. Because there's a seasonal, is the rise because of seasonal forces, or is it real? So in order to get around that, you have to look at inventory only at the same time in past years, and that's what we provided you. The inventory on January 1st was $29.98, compared to $33.98, compared to $37.53, compared to $45.85, all the way back. And there's also another ratio, which is really the supply and demand equation of real estate. It's called the MOS ratio, month of sales ratio. Month of sales takes inventory divided by the sales rate. It represents how fast they're gobbling up the homes. And a low number of months, it's always expressed in months, months of sales. For example, 3.7, it would take 3.7 months at the current sales rate to take the inventory of $29.98 to 0. That's what it represents. So a low number represents a low supply, high demand. Okay, remember it's a relative thing too. 2, let's say a MOS ratio of 2. Is it two units for sale and they're selling at 1 a month? Or is it 2,000 units listed and they're selling 1,000 a month? It doesn't matter. The ratio is what's important. And 3.7 is the lowest ratio we've had in this region, which is very, very strong for a continuation of the price changes as we go forward, okay? All right. Next slide here. Now, we've done the same thing by city. Again, this is for your records. But when you look at decreasing inventory and declining MOS ratios are occurring in almost every valley city. In other words, it's not a statistical thing that's blended out. Maybe 5 cities are doing good, 4 are not doing well, but the average for the whole region is doing good. You know, we don't have that situation. All of them are doing well, except maybe Cathedral City, but that's not much. I mean, 3 to 2.6 difference in MOS ratio, that's no biggie. So it shows that the supply and demand equation for the whole, the whole region shows is strong, is across all the cities. Okay. Now, the other 2 metrics, the little change in the median number of days in the market. Out here we measure days in the market. That in red shows you the whole valley. It takes, a median number is it takes 58 days to sell a home. Last year it took 56. What's that? That's in the attached market, it took 53 days last year, or the year before, 51 this year. That's a slight improvement. Each city is mixed. Nothing's out of whack here. So we have no stresses at all going on in the number of days to sell a home. We're not getting any strange numbers there. Let's just go to the next one, which shows you the price discounts. The whole region, 2.7% for detached homes to sell. It takes that much of a discount. You have it listed for 400. You have to discount it, let's say, 2.7% to sell it. All the numbers are rather consistent here. Indian Wells is getting a little high, but that's not bad. That's still 6.5%. We'll get into that in a minute. Okay, and next slide. Now, here's what I wanted to, this is fun. I always, anytime I come up with something new, it's fun to research, you know, and then try to explain it to you and come up with something I think is important, not waste your time. It's always what I try to do in a challenge. And what we've done here, what's interesting about the luxury market, single-family resident luxury market out here, which are really the $2 million home area, you know, is that 75% of the owners to 85% are remote owners. So it's really a measurement of the remote owner market, not the owner-occupied market. So let's show you what we did. We took our subdivision analysis. Oh, let me backtrack here a second, okay? My background is in stocks. I know, how they do things, et cetera. When you put together what's called an index, let's say you want to know what's going on in the utility stocks. Well, you don't go out and look at Microsoft or whatever. You go look at maybe 10 utility stocks, average up their prices, and you plot that to see what utilities they're doing. Any one can go this way, but when you average 10 utility stocks out, you kind of get a picture of what utilities are doing price-wise and what they're yielding. Same with any type of stock. In other words, putting pieces together of a similar type and building up a metric for that type is what we're doing here. So I did something similar to what they do with the S&P 500, but for housing, okay? I put together 10, I picked out 10 of the top representative, not just one area also, of the top single-family resident subdivisions, country clubs, Andreas Hills and Palm Springs, Bighorn, Palm Desert, El Dorado Country Club, Indian Wells, Old Las Palmas, Palm Springs. Some of these have no HOAs. Some do. Most do. That wasn't the criteria. It was just as it kind of considered in the luxury market. We wanted a broad spectrum to find out what's going on. Vintage Club Reserve, Hideaway, Thunderbird Heights, Toscana Country Club, Tradition Golf Club. And when we put these things together in a mathematical way, like you would coming up with an index, with the average home size, 4,700 square feet in these 10. Average price per square foot, $510. Average price, $2.4 million. Average monthly sales of these 10 is 19 units a month. End of year listings, there were 169 listings in these 10 markets, okay, sub-markets. Month of sales ratio, a MOS ratio, 8.9 months. Average days in the market, 120 days. Okay, that's different than the average, okay, but that's this market. Now let me show you, so now we wanted to see what's going on price-wise. Now you can know what's and those agents here who work a particular market, like Bighorn, Vintage, Toscana, et cetera, you know what's going on in that market because you live and breathe that market. But is there something unique about it? You don't know unless you go out and do this mathematical study, measurement thing. And I went down and I plotted since 2010 the average price of this single-family resident luxury market index. It went all the way down to about $400 a square foot back in 2011. It's up to $507 now. Highest of all time. Thought that was rain, but it's wind. Okay. Now, there is no doubt that the trend is up, but it's not very much up. Okay, I wish it was higher, but it isn't. It's up 2.3%. But in all justice, it didn't fall as much either. During the decline in the crash, the luxury market didn't fall as much, so you would expect a smaller rebound. But it's a positive trend up, so let's celebrate that at least. Okay, let's take a look at sales. So we take the 12-month sales of that group of 10 going back. Any one of them could be up and down, but we saw the highest were up to 19 units a month. So sales in the luxury market, as measured by this index, is the highest we've ever had it, which is a positive. It's positive when you have that on an up pricing market. You don't want to see sales increase as it's coming down. All right? It means sales overwhelming demand. Demand is, sales is overwhelming demand. So let's take the other standard metric, inventory. How are the number of luxury homes? Are they coming on the market heavily, or what's going on? Well, they're down too. Not as much as the overall market. Yeah, go back 199 units in January 2018, down to 212, and then to 165. So you have, and the MOS ratio, okay? Because of higher sales and lower inventory, you have a higher ratio, currently 8.9 months. That's the lowest month of sales ratio for luxury homes. These are positive things. They could be more positive, but they're positive. Okay, let's go on to the And also days in the market and price discount. 125 days, nothing out of whack there. It's been consistent. You know, it's, for these 10 communities, average 125 days. Price discount, 6.9%. It was at one point almost 12% discount to sell a home back in 2012. Here. Okay, so there's nothing going up or strange in these indexes. So as measurements of the market's fine. It's not shooting through the roof, but it's just going right along. Okay, the next slide. And this I wanted to show you. We did a subdivision analysis now for all of Orange County. And what I did, and this is fun. I think it's fun. I picked out 15 of the top luxury markets in Orange County, primarily the beach communities. Now, if you're familiar with Newport Beach or Laguna Beach, you realize they have little enclaves, you know. And so here are our the 10 here of Coachella Valley, the 10 that I just talked about: Bighorn, Hideaway, Toscana, Traditions. Average price in that community, number of listings. This is the standard, all the listings columns that I showed you, right? But what's here? Here we have 15 of the top Orange County ones. For example, Emerald Bay is a famous one in Laguna Beach. Average home price, $8 million. There were 10 listings on January 1st, 17 sales last year. This is the dollar sales. So you can find out that their dollar sales are not that much higher than our areas here. But look at the price per square foot. Yeah. I'm sorry, the price per square foot and the size of the homes. They've got here a Newport Beach, West Newport Beach, $4.4 million homes, average size 2,200 square feet at $2,275 a square foot. So this allows us to compare. I know some of you agents might want this statistics to compare for clients who are in that category, how other markets are doing and what they get when they buy here. Okay? So I just threw this in just for fun and for your edification. I thought you might enjoy it and interest, because it is interesting. Okay, let's go to the next slide. So in summary, single-family detached homes experienced upper single-digit gains. Condominiums and attached homes had lower single-digit gains. This is the summary, what we just talked about. Unit sales were off about 2%, but dollar sales up 4%. Inventory continued its 4-year contraction, putting upward pressure on prices. Luxury market continued its positive trend, even though it's not a strong positive trend. It's not going down or sideways. It's still going up. And the Valley's Moss ratio, supply and demand equation, finished 2019 strongest ever. So that's what the market did and is telling us. Okay, so now, are we into another financial, we're getting off a whole other subject. Are we getting into a whole, now I put a thing called up there, the book. You don't have that on your handouts. I didn't, I know. That's because you say, what gives me the authority to talk about bubbles? Okay. Well, right there is where I wrote a book. Okay. And the book was called A Strategic Guide to the Coming Roller Coaster Market. And if you follow this pattern, you'll find out it came out right there, in which I actually put on the cover of the book, because I thought it was at a critical spot, and I wanted to kind of immoralize it. If I was going to stick my neck out, I might as well stick it all the way out. Because if you're wrong, you're dog meat, you know, kind of a thing. On the cover it says, how a new model of the stock market predicts the end of the 18-year bull market. 18-year bull market was this right here. 1982 to 2000, that's 18 years. How predicts the end of the 18-year bull market and the beginning of a new era. I listed all the reasons why we were in a bubble, and the bubble was breaking, or about to break. Now, nobody noticed because all the books selling at the time were Dow 100,000. Everybody was .com crazy. The reason left, you know. But it does give me And then Wiley and Sons saw the book, and they contacted me. I wrote a second book for Wiley and Sons. But he does give me some credibility to talk about bubbles. So there's the stock market. You've seen the housing market on those other metrics for the region. I didn't show you all the regions, et cetera. Just this region. It shows we're up back near the highs in 2007. Someone might wonder, are we in a bubble? Well, let's take a look at what a bubble is. What are asset price bubbles? Bubbles are irrationally priced assets created by excessive use of leverage. Now, I'm going to take you back to school a little bit here. A bubble is a bubble is a bubble, okay? They're not all the same. But what are they? They're irrationally priced crowd delusions, okay? They are created by crowd delusion, okay? A misassessment of risk. You can say, my prices are way up. Oh, I don't care, it's a different era, everybody's making money. You know, I've been waiting all this time and everybody's doubled and doubled their money and it's going to go higher, everybody says so, so get in. That's the depth of their thinking. There is no bubble if there is skepticism and doubt. Okay? There's no bubble if there's skepticism. In other words, the dot-com, I had a fellow when I was a financial advisor, he didn't have all his money. He had $100,000 he wanted to put into a dot-com mutual fund. This was near the top. And I said, you know, this is awful risky. He said, that's not all I got other IRAs. I want to put it all in there because this is going to go through the moon. So, well, I just written my book. So we had to have him sign a disclaimer that we warned against this, that, you know, so that you don't come out recommending this. And that fund went from $100,000 down to $8,000 in a matter of a year and a half. You know? That's an extreme situation. Price bubbles usually go 100% above true value. They can go higher. That's pretty a general rule. A bubble is a bubble is a bubble. I want to talk about that, okay? Because misconceptions bring a lot of problems, misunderstanding. Because the 2008 or 9 housing crisis, bubble, collapse of the economy, people think of that one. But the price housing bubble, did that create the crash? No. It was because they had a bubble 7 years earlier, the dot-com bubble, that didn't lead to an economic crash. It was hardly a hiccup. So one bubble, the breaking of, didn't create any economic repercussions. And another bubble, 7 years later, created the greatest recession, depression we've had since 1929. What happened? What's the difference? Well, there are two separate issues here. There's a thing called systemic risk. What is systemic? It's only happened 3 times in the last 100 years. That's where the entire financial system collapses and disappears. I don't know if you know this, but in 2008, every bank in the United States was bankrupt. Not every, they won't tell you which ones, but it was the vast majority. Bank of America, Morgan Stanley, every major bank in America was technically bankrupt at a moment, and it happened in about a week. Their balance sheet, they showed they owed more than they had on their asset books. That's by technical, and that's when the government, they ran over to Congress and says, quick, give us $700 billion. And now that's called a what? That's called a bailout. Okay, now I got you, okay. It wasn't a bailout. It was an investment. See, a bailout is like, give me some money, I need it, you know, you can pay me back if you want. All that money was paid back, by the way, all $700 billion was paid back with interest. We made $100 billion as taxpayers on that investment. But they needed money to invest into the banks. They bought preferred stocks. The government owned it. Preferred stocks. That left the balance sheets up. And suddenly no one was bankrupt. And they got by the crisis, okay? So that's a systemic, that's where a bubble, and Katrina, was Katrina the disaster of that hurricane? Was it the hurricane? No. It was the hurricane. There have been bigger hurricanes, but that set up a series of forces that collapsed the levees. Two separate things, hurricane and levee, not related. The levees are constructed. If they're badly constructed, a little hurricane is going to cause a disaster. Big hurricane might not do anything if the levees are strong. So it was our economic system. The Federal Reserve didn't do their job, ladies and gentlemen. With all these derivative products that came out, they set up an interlocking financial web between all the banks. That was like a weak levee, and the hurricane came along and the levees broke. The same thing. So it's a good analogy. So I won't delay you with any more. There is no apparent price bubble. I'll give you the answer to the question. Are we in a bubble? No. My opinion. I think it's well-founded. Asset prices, stocks, bonds, and real estate seem at this time to be correctly and fairly valued at current interest rates. That's the key. Interest rates are the most important variable in calculating what an asset should be worth. With low interest rates, we're entitled to the current asset prices. There is no systemic risk to the U.S. system. Is there a systemic risk to the global financial system? Yes. The next problem we will have will not be in America. It'll be the collapsing of the global economic system created by the international banks of trade and their financial products. We're going to be blindsided. We'll be looking at ourselves. Are we okay? Are we okay? Are we okay? And then the big wave will come from outside. That, I think, is the main. But there's nothing showing that this could happen yet. And we probably won't know if it is happening till it happens, because we don't have good metrics in that area. Okay, that ended the bubble part. Okay, so don't think we're in a. Don't worry, prices are going to go higher. There's not much risk. That's what it all is leading into. Okay, now what are people really worried about? It's this. What the heck is this? This is 1920, and the dark colors here are the recessions. This shows you industrial production. And I'm just putting this up, nothing to show you about industrial production. That's just showing you an economic measure. But I want to show you how often you have recessions. The longest period of time between recessions is, I think, 10 years. It was back in the 90s. Right now, we're 10.5. So that's what everybody's biting their teeth on. All right, is it going to go farther? Are we going to go to 15 years? Boy, it never has. But we've got some strange things going on. It might. Okay, well, are we on the verge? That becomes the question. Let's go to the next slide. Why do you really care? You care because of the following reason. This shows you, back to 1950, again, you see the recessions. I want you to look at this very carefully, because this is important. Why recessions affect housing is primarily due to the loss of jobs during a recession. Every recession, you'll see, this is unemployment, 3%, 4, 5, 6. Notice back in 1950, it went from 2.5% to 6%. Those are people losing their jobs. When they lose their jobs, they have to move out eventually because they can't make their mortgage payment or it's at risk. That puts undue pressure on home prices, and you'll see inventory starting to rise if we go into another recession. Again, which we don't see yet. But this is why it can affect you. It's because it affects unemployment. The economy itself doesn't affect housing. It's the indirect effect on the homeowner losing jobs. Generally don't lose wages too much. Their salary they don't drop their salary too often. Sometimes they do. But it's the loss of jobs, and these people now have to sell, and rather quickly, so the supply comes up, and then that puts pressure on home prices. That's the main worry. So let's go. I want to show you something on the next slide. I'm going to show you, we're going to go back to school here again, because I got to show you what to look for and why to look for it, because is there a recession coming? Well, let me just say, okay, let me have your attention. In economics, there are types of indicators defined by time. There are what they call leading economic indicators. Those are the first things that go up and down before the economy goes up and down. Economy, how would you measure the economy like right now? Well, retail sales. If that's retail sales at this very moment, calculating, that tells you how things are going right now. That's in the present. That's not leading, that's right now. Gross domestic product tells you right now. So what leads these things? Okay, well these 10, they have 10 of them. I won't go through all of them. Notice the stock market's one of the 10. They found these 10 in total lead the economy. Notice this thing spread between long and short-term interest rates. That's the famous spread. Everybody talked about it last year. The problem with last year, everybody forecast a recession last year, almost everybody did, because they were looking at one of the 10, and it was negative. Didn't have a recession. Their mistake was looking at one of the 10. Look at all 10, okay? And you will find, go through those are examples of other indicators. Notice unemployment rate is a lagging economic indicator. Now, what advantage of this is to you as a real estate agent? You got a lot of lead time. Because things will start happening in the economy 6 months to a year and a half before you're going to see the tail of the dog, unemployment rise, and pressure on home prices. Stock market people don't have that benefit because they're one of the 10 leading. You know, there's nothing to indicate to them when the market's going to go down because they're the one telling the market what's going to happen with the economy. So, but that gives you an advantage. So it's important to take a look at, and here's the next slide. This is a picture, the bottom line, of the 10 leading economic indicators. See that? Right here. Those are the 10. This is unemployment. And this is the peak in the last 3 recessions. Notice the 10 indicators, 10 leading indicators peaked before you had a rise in unemployment. So there's plenty of time. Notice that the latest reading at the end of this year, December, was right here. There's no sign at all of the most important metric that economists have developed that point to a recession, showing any sign of weakness at this time. And normally, it will peak maybe a year, 6 months to a year before a recession. So, I'll just point that out to you. Okay. So, let's go to the next slide. Economic summary, we are experiencing an extended time period of moderate economic growth with low inflation. Either economic growth, inflation will begin to accelerate and we extend the recovery into 2 or 3 more years, or the leading economic indicators slowly roll over and we move into a recession in 2021. But I don't think we have any worry this year. So that was the summary on that. I think things look pretty good. It's a lot of worry about worry. People are worried and fearful. But when you find out why, they're, well, I'm just scared. Why? Give me the statistical reason why you're scared. Well, I don't know. There's nothing really. It just doesn't feel good. You get those kind of answers, you know. But we're going to show you let's go back to the previous slide. Let's see. Yes. We're going to show you the forecast for this year, 2020, and let you go. Okay? But before we do that, we want to show you last year's forecast because it was a very unique period. It was in February of last year. Everybody was negative. I remember a gentleman sitting right about over here after the talk because we were very optimistic. I'll show you some of the slides. He said, well, what do we tell our clients? They're also negative. I said, well, tell them what we just showed you, you know. So I'm going to show you some of those slides. Last year, almost every real estate forecast, this is February, was moderate to negative on 2019. Prices were too high, higher mortgage rates were going to hurt housing, less affordability. Everybody was accentuating the negatives. And I talked about babes and old-bucks. Babes and old-bucks is an old idea, contrary opinion. In other words, when everybody thinks one side, you have to look at the other side. There has to be a babes. Babes and old-bucks means broadly agreed to, but essentially wrong scenario. Old-buck stands for occluded, but ultimately the correct scenario. In other words, when everybody starts going one way, you start looking for the things that they're missing in their argument and thinking. And you will find that there is something that's going to show why the market's going to do the opposite of what everybody expects. It's an interesting feature of contrary opinion. So, and we said, let's show you the positives. Don't let short-term events, back then the stock market was down 20%, the Federal Reserve had raised rates, everybody was negative on a number of things. Follow the indicators and stay rational. That's what indicators are for. And we gave you these. Celebrating the positives. 2018 produced the highest standard of living per person in the history of the United States. It was $57,200 per person. This year it's $59,000. It went up even more this year. Right now we have the highest standard of living per person in the history of the country. Okay? Next one. Back last year, and it's been getting better, all income brackets, the lowest 25%, the next 25%, all had after-tax income the highest in history. Well, the politicians didn't tell us that. Well, no, politicians, you might say politics is the art of making everything look bad. Okay? Because it wasn't as bad as it was being portrayed. Okay? And then also household net worth. It was $106 trillion last year. Now it's $114 trillion. So household net worth is as highest it's ever been by far. Okay, and these were some of the positives. We got into some other things. But we wanted to shake everybody out of their negative attitude, showing that things were positive nobody was talking about. And we showed you this indicator too. This is the leading, last year I showed you the 10 leading economic indicators. And we used this to make our prediction. No recession last year in 2019, even though everybody said so. After 10 years of recovery, the 10-year leading economic indicators seem to point to further good times for at least another year and a half. That's what we said last February, and it turned out to be correct. We're trying to say follow the indicators. Don't follow your feelings. The indicator said no problem, and then there was no problem. Okay, so let's get into the forecast. Another positive year for value home prices, up 7% for detached homes and 5% for attached. Might even be higher. We expect a very good year this year. Unit sales, 9,800 unit sales, $5.2 billion in dollar sales. Continued increase in value home ownership rate. The owner-occupiers should continue to increase. We're getting that. And the remote owners are stable. We're not getting much growth. There's getting a little bit of growth, but not a lot in remote ownership. Unless unusual events occur, the leading economic indicators currently forecast no recession in 2020. So we're saying it again. No problem this year. Okay? Interest rates should remain near current low levels. You're going to see sudden drops in the market, but I don't think you got to top there at all either. So nothing negative, really. You can talk about SARS. SARS is a little bit of an unknown, not SARS, coronavirus. That's a little bit of an unknown, but it seems like the numbers are not growing exponential. They're starting to curl over, which is a very positive sign. I think you'll see that contained, and hopefully there'll be no repercussions on that. Okay, and now finally, new homes. We forecast, how many new homes last year, Vic, did we forecast? 920. It came in at 920. No. What did we forecast? It was 920? No. It was within 10% of that, so we were pretty close. Yes, this year we should break 8,000. We're projecting 1,005 units. Also, over 80% of new homes, there's market there for you. As you know, Toscana offers compensation. Didn't always used to be that way around here. The new home market's offering it too, okay? For 80% of the developments out there, you can make money offering new homes. Okay. That's about it, I think. Is there another slide? That's it. So, we try to give you a summary. Thank you.